Hello everyone, my name is Kai-Shen Chen. Today we're exploring how Australia's accounting standard will define control from the rule-based AASB 127 to the principle-driven AASB 10. We'll focus on three key differences: the definition of control, handling complex ownership, and the impact on financial statement. First, the definition of control. Under AASB 127, control relies on ownership percentage, like holding over 50% of the voting rights. But AASB 10 changed the game. Now control requires three elements: power over the investees, exposure to variable return, and the ability to link power to those returns. AASB 127 focus on legal ownership and voting rights. For example, a 50.1% stake means control, but AASB 10 looks deeper. Even with 40% ownership, if you hold power like contractual rights to direct key activities, you must consolidate. Next is the complex ownership structures. AASB 127 struggled with minority stakes or special purpose entities. If ownership was below 50%, control was often ignored. However, AASB 10 fixed this. Its principle-based approach assesses power in SPEs or contractual arrangements. Lastly, the impact on financial statement. AASB 10 expand consolidation. SPEs, joint ventures, and entities under control in fact can now appear on balance sheet. This increases assets and liability, alters leverage ratios, and enhances transparency. It also aligned Australia with global IFRS standards, improving comparability for investors. Overall, AASB 10's principle-based approach modernized control, prioritized economic reality, and aligned Australia with global practices.
Hi everyone, I'm EJ Huang. Today I'm going to present regulatory perspective on control concept and briefly compare among WSB 127, WSB 10, and US GAAP. This is my thesis statement. I'm going to discuss why WSB 10 is preferable in regulatory perspective. Here are some advantages of WSB 10. First, WSB 10 enhances transparency and comparability, which align Australian with global IFRS standards and reduce potential for off-balance sheet financing and provide investors with a true picture of a company's financial position. Second, US GAAP is rule-based, which can lead to company structure transaction to avoid consolidation, while WSB 10 is principle-based, meaning it adapts to complex corporation structure without rigid definition and provide more flexibility. Third, WSB 10 consolidates structured entities and make their financial statement more reliable for stakeholders. It also helps regulators identify financial risks earlier. Fourth, US GAAP is being more rule-based, can lead to inconsistency when compared with IFRS-based jurisdiction. WSB 10 aligns with IFRS 10, which enhances cross-border financial comparability for global investors, making Australian financial market more attractive to international capitals. Finally, companies could avoid consolidation by minimizing direct voting power while still exerting influence under WSB 127. However, WSB 10 eliminates this by defining control beyond voting rights, ensuring substance over form. While US GAAP and the WSB 127 are lack of the adaptability required for modern complex corporation structure, WSB 10 offers a more robust and fair representation of control.
Hi, I'm Yelin Du. This part is about the potential negative effects of the old control compared to the new control concept. As we mentioned in the previous section, there are significant differences in the definition of control in Australia between two control concepts. In my opinion, using the old system AASB 127 may bring two potential negative effects of incomplicated information and insufficient risk identification. First, the information is incomplete because the definition of control is too depends on the voting rights, like 51% ownership, and ignore the actual control through contract or other means. This results in the entities with less than 50% ownership, but actually control not being included in the consolidation statements. That can have some really important financial information. In the real world, Aaron is a prime example. The company decided a special proposed entity with less than 50% ownership to head huge debates and influence profits. This is formally in line with ASB 127, but avoided disclosure of actual economic control and finally led investors failing to recognize the real risk and resulted in a bankruptcy scandal. Additionally, the problems of the insufficient risk identification is so prominent in the case of ABC Learning Centers. The company similarly to use spies to hide debts, inflate revenue and assets, and mislead investors about its risky expansion. People made positive investment decisions based on the company's disclosed financial statements and drove up the stock price rapidly. But once the issue came to light, investments suffered serious losses. The old ASB 127 model didn't really give a full picture of the company's finance, making it tough for stakeholders to assess risk properly. In conclusion, the limitation of ASB 127 is that it ignores accounting for substantive control relationships. By contrast, ASB 10's framework ensures more complete and transparent financial disclosures, offering stakeholders a more reliable basis for decision making.
To conclude our video presentation, I will now compare the concepts of control under the IFRS and the US GAAP. According to IFRS, control exists when an investor has power over an investee, exposure to variable returns, and the ability to influence those returns. It's principle-based and focuses on the substance of relationships. For US GAAP, control typically requires majority voting rights or is determined through the variable entity model, which consolidates entities where the investor absorbs significant risk or rewards. It's more rule-based. The main differences between these two frameworks are, first of all, the scope of consolidation. Indeed, under IFRS, broader consolidation can occur due to its principle-based model, which evaluates economic substance rather than strict rules. US GAAP's rules-based approach might exclude certain entities from consolidation. IFRS allows non-controlling interests to be measured at either fair value or proportionate share of net assets, while US GAAP mandates fair value. IFRS permits partial goodwill recognition, while US GAAP requires full goodwill for all business combination. US GAAP might show higher goodwill balances for longer period, impacting total assets and profitability ratios. The financial position of US company may understand liability or overstate profitability. Overstated goodwill can inflate total assets and give a misleading picture of the company's financial health. And financial ratio like debt to equity or return on equity may differ due to this valuation difference, requiring adjustment for good comparability. In summary, the principle-based IFRS provides flexibility, while the rule-based US GAAP ensures consistency. Investors must carefully analyze these differences when making cross-border investment decisions to ensure accurate comparison.